Hi, good afternoon. I would like to welcome you to this webinar on finance from futureSME. futureSME is a trans-European consortium supported by the European Union, which has developed a new business model for small companies. My name is Dennis Carney, and I am the moderator for this session. The presenter this afternoon is Jack Hartley, whom I will introduce shortly. The purpose of the session today is to provide guidance to managers and owners of small companies in how to approach financial institutions, particularly in relation to accessing new finance. We will have time at the end of the webinar for questions and discussion. In terms of webinar protocol, all attendees are in listen-only mode. However, you can ask questions by using the question box on your menu, and you can submit these at any time. I will consolidate them and make sure that they are addressed by Jack at the end of the meeting. We will conduct 2 polls during the session, and also we would appreciate if you answered a survey which should pop up after you leave the webinar. Also, if you would like a copy of the presentation, please email me at the address given at the end. I'm now going to ask you to respond to the first poll. This poll is asking you what background, the type of audience we have today. It should be up on your screen now, and I will give you a few seconds to answer it. Okay, I think everybody has answered it at this stage. So what I will do, I will close the poll now and let you see what the results are. You see, basically we have kind of almost a third mix between general management, business owners, and consultant trainers. So, Jack, that should give you some idea as to the type of people we have today. I would hide the poll now. So, I would now like to introduce Jack Hartley to you. Jack is who is your presenter today. Jack has recently retired from the Bank of Ireland, the largest financial institution in Ireland. Over the last several years, Jack has been responsible for the SME sector within the Galway area, and he has helped many of these companies to get their businesses off the ground. He is well aware of the problems that small company owners face in dealing with financial institutions. Jack is also, by the way, a barrister and is a member of the Institute of Taxation. As an introduction to Jack's presentation, I'm going to put up a second poll, which is a little bit more specific and which is trying to see how involved you are in the financial management of your business. This is a multiple choice questions, and so please tick all those that apply to you. I'll give you a minute or so to answer this. I think everybody has answered it at this stage. Well, I hope they have anyway. I see most of the votes are in there. It's probably maybe 1 or 2 more haven't answered it. So I'd maybe give it another few seconds. Okay, I think we've got all the answers that we're going to get at this stage. So I'll close the poll, and you can see the results on your screen now. And Jack, I'll let you have a look at those. I think there's certainly one result sticks out for me, which is the last one, which said that nobody believes that their banker understands either them or their business. So I'm now going to close the poll, and I will hand you over to Jack, who will make his presentation. Okay, Jack, over to you.
Thanks, Dennis. Just loading up my slides there. Okay. I'm assuming everybody can see my slides now.
Yes, we can, Jack.
Thanks, Dennis. Thank you for the introduction, Dennis. And that second poll was very sobering, and it certainly puts a slant in my mind in terms of how I'll handle these slides. The key one being my banker understands my business challenges at 0%. So that's a fairly not unexpected, but nevertheless it does create a poor basis for constructive exchanges of information, which is what I'm talking about today. It's heartening, however, to see that 38% regularly review the management accounts, and the other one which I'll touch on is 38% say the financial controller puts the numbers together, and the other one says 38% understand working capital, and those are interesting numbers as well, particularly the working capital one, which I will touch on. The other question in the poll, I know the financial challenges we're facing. It's good to see 2/3 respond to that. It's unsettling then to think that 1/3 of them don't, but that might be for other reasons other than just they don't know them. And the mix of people listening, it's a good mix, and interestingly enough, there are 0 financial people in the mix. So actually the audience is good from my perspective today. Okay, so just in terms of setting out my stall as to what way the presentation would run, the basis of my presentation fundamentally is that if the customer SME has an insight into the process that the banker must complete to get sign-off for a customer loan request, then the customer can facilitate the process by presenting the required information to the banker almost on a plug-and-play basis. This effectively means that the SME will have more impact and control on the desired outcome, i.e. approval of the credit or loan request. Just to say from my experience, generally the frontline bank manager or business banker, and there are different titles for all these people, but it comes down to the same thing. We call them the bank manager, has very little discretion nowadays to approve a credit application from a customer on their own bat, except maybe for smaller amounts. The Bank of Ireland process, which is my experience, is that the business banker or bank manager takes the information from the SME customer and uses that information to complete a loan application form, which is then sent to a separate credit underwriting function in the bank for approval. And this is the whole theory of checks and balances. The frontline guy supports the customer in the credit request, and the credit underwriting guy stands back and assesses it from a cooler distance, so to speak. Ultimately, the frontline banker has to add their recommendation to the application, and assuming the banker has a reasonable skill and experience, the differentiating factor from where I sit will be the quality of the information in the application, which will underpin the frontline bank manager's recommendation. So really a lot comes down to the loan application form, and often in life it comes down to these practical kind of things. If the SME owner has some idea, and this is my fundamental premise, that how that loan application form is laid out, then perhaps they can feed the banker with the appropriate information to facilitate the process and influence a positive outcome. Rather than waste energy debating the system, I have noticed that practical business people reserve their energy to manage the process in the bank as effectively as they can to get the desired result for themselves. There are 19 slides in the presentation, but there are 5 key slides, numbers 8 to 12, which I will focus on particularly, and 2 of those are numbers based, which again I will focus very carefully on. Now, I'm not going to get into detailed numbers. It's just to give you a sense of the structure overall, and you can always come back through futureSME if you want to hear more about that. If you were to take a couple of key points away, I would consider it a result, and those to me would be know your own big numbers, your financial numbers, and also have timely, up-to-date information. So without further ado, I'll kick into the slides. So the first slide is a summary of the loan application layout from a Bank of Ireland loan proposal. And I suspect that this travels generically across banks, that they would have similar type approaches. So it's a 7-point document, and the first slide outlines the 7 areas, and the following slides will deal with each of them in a little more detail. So the first section on the loan application is, it describes the company structure, and I'm assuming we're dealing with corporates mainly, although sole traders may be listening in as well, but it should equally apply to them in terms of what their business structure is. So how the company is set up, the ownership, and who manages it, the type of products or services that are sold, the key customers and markets, and the operations. If you like, a snapshot of the company, and typically if you're an existing customer in the bank, that information will have accreted over time and will present just an update onto the history of the relationship with the company. The second section is the bank account operation, and the bankers will have almost a picture of your current account and overdraft over the last 12 months, and they have a very quick eye to see how that's being managed as it presents itself on the screen in a summary format. So things like forced credit or excesses, as they call them, or overdrafts which don't revert into credit for 30 days in a year. These kind of things stick out like a sore thumb, and the bank manager sees them, and he knows or she knows very well that the credit underwriters will spot it in a flash, so they have to deal with these things up front. And if you feel they're being picky on this stuff, it's because they have to mitigate any issues there and explain them to the underwriters who will pick them up, because these are indications of how you're managing the finances of your business through the cash flow, which is effectively reflected in the current account. In retail banking, the products are fairly straightforward. It's either overdraft or term debt. There are other types of products, but I'm going to focus on these 2 main ones. And a term loan really is not rocket science in terms of reviewing it or examining it for performance. It's make your payments on time. The 90-day Basel rule there in brackets says this is an international banking agreement in terms of monitoring banks as to how they monitor credit, and it's effectively if a loan or a contract is out of order for 90 days, then it drops down in terms of credit risk, or should I say it goes up in terms of credit risk, but there is a credit rating on every loan and overdraft, and that's hit immediately if you're more than 90 days in arrears in a loan. So it's a big signal for a banker in terms of management, and it has an external impact for the bank in terms of the regulators, and it has to be dealt with. The third section on the loan application is the summary of the current loans, and this one has an impact later on, and I'll touch on it again, but basically it details all the loans that the customer has from the bank, and it details the total repayments. The security section deals with the tangible security that's at the fallback if the bank has to rely on it where a loan is not being repaid. And you would all be very familiar with that concept. But the key pieces in it in terms of the banker putting forward a credit proposal is what is the current value of the security, if any, held, and is it liquid, i.e. can it be sold in the market, and is it marketable? So they're the key commentaries that the bank manager will have in the loan application in terms of security. And sometimes you will be asked for an up-to-date professional valuation of the security so that the banker can give comfort to the underwriters that the loan is well secured. Here's one that is not so obvious initially, but it's the personal balance sheet of the promoter. And the promoter in small companies typically is the owner, director, and probably shareholder as well. And certainly in my experience and in Bank of Ireland, small companies with balance sheets perhaps that aren't overly strong are typically asked to sign personal letters of guarantee and back in their own personal wealth in behind lending to a company. Now, I'm not here to debate the rights and wrongs of that, because I know it's an issue, because I have sat across tables from IRA customers in terms of this requirement. But the point about it is that if there is a personal guarantee in there, then it's obviously backed by the personal balance sheet of the promoter, and typically then the bank manager will want an updated version of that to ensure that there is some strength behind the personal guarantee. Additionally, promoter's balance sheet or statement of affairs will indicate if there are any personal over-borrowing issues which may cause the promoter to come under pressure personally from a bank, which might cause the promoter to put a bit of pressure on the company in terms of extracting cash from it and create an additional risk there. So these are the kind of indicators that you're looking at under this heading, and you will have commentary, hopefully positively, but if there's any issues going on, you need to deal with them, because these are risk issues in terms of lending to a company from the bank's perspective. Now, sometimes this is the core piece that's often overlooked, because SMEs tend to want to describe the business without cutting to the chase of the request, and a request has to be summarized, and I'm summarizing it in this way, and this is how it's put into the credit application. So I'm taking a case study that I've lifted from a training manual internally, and these are very small numbers, but it's just to give you the sense of how these loan applications are put together. So here, Section 6 says, right, the underwriter is reading this and he's trying to find out what the customer actually wants here. So you have to be clear about what you want so that the bank manager can frame this section clearly. So in this case, we're looking for refinance of a residual term loan. So there's 3,000 of a balance left in a term loan that this company has, but they want to add another 57,000. So the total request is 60,000, and they want 10,000 by way of overdraft. And the purpose they're stating is 30k to finance and development of a new range of products. That could be new machinery, whatever. 27k is being asked for working capital on the basis that they're going to have increased sales, and I'll touch on that in a minute. And they want 10k for overdraft for contingency purposes. So their total then exposure to the bank would be 60k of a term loan and 10k of an overdraft, which, when you think about an overdraft, is effectively an interest-only borrowing on an evergreen basis. But just something to note there, that often companies like to get an overdraft, but remember that an overdraft is repayable on demand. So if there's pressure on a company and a bank loses a bit of confidence, they may be within their rights to pull the overdraft. Whereas if you financed it by way of term debt, which is a contract on the basis that you will keep your repayments up to date, then that is not, the bank can't cancel that without your breaching contract. So if you keep your repayments up to date, you ensure that you retain the credit facility. Just, it's a small point, but worth noting. The term in this case is 5 years, and the proposed interest rates is the bank cost of funds plus a 3% margin, and this is typically how these things are framed. So that gives you a mathematical calculation, which is 60,000 overdraft over 5 years at an interest rate. What are the repayments? And in this case, it's 14,000, and the existing repayments then are nil, and there are no other repayments like finance leases, etc., or payments to another bank. So that's the framework of the request. The financial information to back the request, and this is my own view of generally what we look for in banks, but it's your latest financial reports, i.e. they're the ones prepared for compliance and statutory purposes and for tax purposes, and usually they're up to 6 months out of date or 6 months old, and sometimes historically they have been, in our experience, much older, but now we like to get them within that time period. And included in that, then with that should be management accounts, which would include the current year and next year forecast under the subheadings of a profit and loss, a cash flow, and a balance sheet. And this is where I think managers, hands-on operational managers who are not experienced in finance, tend to have a discomfort with. And it's not something that you can make go away, but with a bit of work, maybe you can get in behind some of the key numbers in this information without delegating it entirely to a number cruncher or a financial person other than yourself. The latest management accounts, which shows the run rate against forecast, and these are very critical. And just a point on management accounts, when those are finalized into a balance sheet and a profit and loss at the end of the year, we in banks would expect that they would not be too different to the latest financial reports. In other words, your management accounts should not suffer major changes. when they're being translated into financial reports. Otherwise, you have an issue in terms of managing business with numbers that might be subject to change at the end of the period. Now, here's how we go through the financials, and I suppose my own view of this is like that financials are the shorthand measurement of activity. So they're not the activity, but they're the measurement of activity, and they're the best shorthand we can come up with. And what we do is we try to present them on a tabular basis year by year, as you can see here. So now you got a trend of 3 years. You have last year audited, current year audited. You will see. I'll just take a highlighter here to just point up stuff, so you can see. Pardon my shaky hand here, but you can see the turnover or sales, and you can see them year on year increasing. So straight away, the big numbers tell us here that this looks positive from a sales point of view, which I personally have always focused on that top line, because I've always felt that costs tend to look after themselves, so to speak, but the sales are the real issue for any business to succeed. So those big numbers look okay to me. Also, just note that we pump these numbers from your financial information into these spreadsheets, and we have efficiency. As a result, we can do it by sector by sector centrally, so we can have an idea of what kind of growth rates are expected in sectors or what are being experienced, and we use them as comparators from an efficiency point of view. Personally, I believe we should start sharing those more with customers, but perhaps there are issues around that in terms of sensitivity and quality of data, but I think it's maybe a trend that should be explored. So the gross profit in these terms, again, looking at the trends, looks fairly solid. So the question, the commentary would be something like, look, are those sales sustainable? What's happening in the market? What are the marketing plans? What are the competitors doing? Those numbers drive out all those questions that preoccupy most SME owners pretty much every day. The gross profit is another big number, and that looks like it's holding. This is a very top-level commentary. Now, the costs obviously are a key factor, particularly nowadays, given the climate. And the costs look like they're, as a percentage of turnover, look like they're fairly static here. So if there are any issues here, you might go in behind these numbers and look at the breakdown and see what the bigger numbers are there and how they are performing over time. And that's where your management accounts will come in, and your forecasts to see where you see that's going, and that's indicating to bank manager how you're managing that business proactively into the future. Again, the net profit figure, and apologies if this is all old hat to everybody, but I think it's still worth restating the obvious. The net profit margin here looks fairly solid as well going forward, and you're looking at any non-recurring items, any bonuses that you got that are padding out those numbers that may not happen going forward, or anything unusual in there. And these are just to follow the trends. That's the profit and loss, and now you're moving into the balance sheet. And really what I want to get at here is who's taking what risk where, and what is the trend on the balance sheet, who's funding what. So the total assets on this balance sheet are, as you see there, it's a small balance sheet, but nevertheless it's a decent looking balance sheet. So you can see that the owner's equity stake is going up, because I think they're making more profits, and also they raise some additional equity.
Hi, Jack. Can I give you a five-minute time check, please?
Yeah, you can.
Okay,
Thank you, Dennis.
right.
Okay, so the net worth of the company as a percentage of the total assets is growing. So the owner stake is increasing. The bank debt is falling. So the bank gearing is going down. So these are all positive trends. And the external people funding it, the non-bank creditors, they're funding about 40% of the company to 30 to 29. So you can see that there is no big risk in this company that one big creditor would pull and there would be a credit squeeze in the company. All these trends are positive. So I seem to have come to a bit of a standstill here on the...
Go into the drawing mode and select non-drawing.
Thank you, Dennis. Okay, kicking on. This is the key slide then, the repayment capacity, and this shows you the cash flow. And as Dennis given me a bit of a time warning, I better move on in this. But again, it's extrapolating the numbers on a trend basis, and it's looking at the cash generation of the business. Now, I can't take you into this in great detail, but I just want to let you know that this is an exercise critical to ability to repay a loan. So I'm just going to use the pointer here. The net profit before tax is being driven off your profit and loss figures in your audit accounts and here in your projections. Non-cash items that are included in there are added back. So non-cash is depreciation and amortization. You have to take my word for that if you don't know it, but it's worth getting to know these numbers. We add back the bank interest that's in the profit and loss. If you look at your profit and loss, it's taken off in your profit and loss. So that's added back because we will be including that in our repayment to the bank in any case. And that gives you this famous EBITDA that we talk about, earnings before interest, tax, depreciation, and amortization. And that's essentially the cash that's there to repay debt. You'll have other things, and in this particular company, they raise cash from new shares issued. So you can see that in the second column here. So here's the cash being generated by the company, and here's the cash being used up by the company. So if you have more working capital, if your debtors increase or your creditors squeeze down or you build up more stock year on year, that will add or suck cash out of your business. In this case, there's working capital being used up, and basically because they're getting increased sales. Tax is going to take cash out of your business, and if you do any capital expenditure that's not financed other than through cash, it's going to come out here on this cash line. And then there may be miscellaneous, which in this case was a dividend. So here is the cash generated, 2361.42, and here is the cash being used up in the business, 1052.22. So the surplus cash is 13.9 or 20. Now, I said, if you remember earlier in the slide, that the new bank repayments were 14,000. So this company has 20 grand surplus to pay 14 grand bank repayments, and 20 over 14 is 1.53, and that's the ratio of surplus cash to bank repayment. And 1.3 is a good number there, but if you don't hit those kind of numbers, you have an issue. So it's worth knowing these are the kind of maths that is going on behind the credit application. So finally, we having gone through that, we'll assume you've crossed those hurdles, and we'll restate the business case in section 6. We'll restate the amount and purpose. We'll have a summary comment on the current account operation. We'll have a summary comment on the repayment capacity as laid out in the previous slide. and then we will comment on the following: the management quality, the business sector risk, the financial risk, the competitor risk, the capex the capital expenditure that you may need to increase your buildings, your equipment, etc., that you may require funding for, and the security, the value of that, and what it's likely to be like in the future. And those are all, if you want more details on that, they're in annexes at the back of these slides as laid out there. So that's the final and the final piece then is the overall recommendation, and this is where the bank manager supports you, and that's really their discretion in terms of adding their own word to and support to the application in the sense that they believe the story and are prepared to put their reputation behind it. And believe me, they watch their reputation carefully in these cases. So they outline the strengths and the weaknesses, and they deal with any issues up front so that the credit underwriters don't catch them in a sort of an ambush where they said, look, you haven't said this, but we've spotted it. Deal with it. So warts and all approach, and it's best to present yourself that way as a customer as well. But if you have risks, acknowledge them but mitigate them. And that's it. Thanks, Dennis.
Okay, Jack. That's fine, Jack. Thanks very much for that. I think that was quite an interesting presentation, and it's quite easy to get lost in the numbers. Certainly, if we're looking at this, it can get quite complicated when you're not a financial person. And actually, I'm going to move on to maybe spend the next 7 or 8 minutes on a couple of questions from the audience. I'll just ask the first one here, which has come in, which is asked, does the personal relationship with the bank manager come into the application anymore? Or how important is that, Jack?
Well, actually, it's a good question, Dennis. And have I still got the slides?
You have indeed, yeah.
I've lost them now. Okay. Well, the point I'm trying to make is that the track record of the management is critical, and some of the stuff that we would comment on there would be their track record in terms of setting budgets and achieving them. So doing what they say they did, or achieving what they promised is a key one. Also, their comfort area in terms of what they're doing, in terms of managing their business and trying something new, etc. You know, it's all about track record, and it's kind of common sense. So, if that's the question, personal relationship, it's how well the bank manager knows how you can manage your business. It's also probably critical to get on with them, but it's very hard to predict that between people. And I suppose both sides are doing their best on a professional basis to ensure that the other is achieving what they want. And I suppose that's life in general, really. So if you're coming from a premise which worries me a little about my bank manager doesn't understand me, I think you can't just leave that alone. You have to try and work on that to see what would make them better understand you.
Okay. I have another question, Jack, which is, I suppose, comes off from that a little bit, which is a question about financial controllers. So that this person doesn't have a financial controller in their business. So what can they expect from their external accountants to support applications?
Well, traditionally, Dennis, I've noticed that the accountants in Ireland charge a fee for statutory accounts, which is done for company law purposes and also for, well, secondarily for tax, for tax payments. But beyond that, that has been their focus. So that typically is what you're paying for, and if you want more than that in terms of consultancy on your management accounts, preparing your management accounts, analysing them, and drawing out KPIs from them, you're going to have to proactively push that, and maybe you could end up paying a little more for it. But in my view, it's well worth it, because it should seamlessly plug and play into what we are doing in the bank in that loan application layout that I just presented to you. But having said that, you can't fully delegate all those numbers away to the financial controller, because you end up inside in a meeting with the bank manager and you continually defer to the financial or the accountant in terms of the numbers, and the bank manager is starting to wonder, look, does this promoter owner actually know their own numbers? Which, if you were taking away anything today, would say try and figure out your key numbers and show that it should be for yourself as well as a business manager, but show that you're managing your business to key numbers which really map across to key performance indicators that you set for yourself and your business.
Okay, Jack. Thanks for that, because we are moving close to our end point now, so I won't take any more questions. There's one short question that I will address myself, which is that, is there a copy of the slide deck available? Certainly there is. And another short question is, what help can futureSME give us? And again, if you want to find out that, just send us an email at the address which will be provided at the end of the presentation. So thank you, Jack, very much for your presentation, and I hope the audience got something out of it, something out of the presentation. I suspect they did, because it was quite interesting. And okay, so we've reached the end of the webinar, and I'd like to thank all those who joined the webinar as well. And as I said, this is the last in the series of webinars that futureSME are running this week. I just put up the list there of the 6 webinars that we ran this week. And looking at the audience that came today, I've seen some of the names before, but I also note that there are many new names there as well. We have made recordings of all of the webinars, so if anybody's interested in seeing these, we will be putting them up on the futureSME website in the near future. So if you send me an email, and I can give you the link to that. Also, as I said earlier on, if you want the copies of the presentations themselves, also send me an email, and we'll give you a link to those materials. So thank you very much for coming today. The presentation is now over, and I'll be shutting it off. So goodbye.